Can you imagine working 80 hours a week on Wall Street, surrounded by experts who are breaking their heads trying to beat the S&P 500? Well, surprisingly, more than 90% of those professionals fail to outperform this index in the long run. What does this mean for you and me? It basically means that the S&P 500 is not only a key indicator of the US economy but also one of the best. There are many places where we can choose to invest our money, but a common question always seems to come up. How can I invest in the S&P 500? Clearly, the easiest way to do this is through ETFs, but from there, another question arises, hacia dónde? Which is the best ETF to invest in the S&P 500? With so many options available on the market today, it's very easy to get confused and not know exactly where to start. That's why in this video, I'm going to show you the main ETFs that track the S&P 500, their key features and characteristics, and the specific reasons why you might choose one over another. The best part is that no matter which one you choose, they all aim for the same goal: to mirror as closely as possible the performance of the 500 largest companies in the United States. The big advantage of investing in the S&P 500 is diversification. Having the largest and most established companies not only from the US market but also from around the world in your investment portfolio, since we know that the United States is home to many of the world's companies. The largest in the world, to be redundant. However, since there are multiple funds that track the same index, it might seem redundant to buy more than one at the same time. Many people wonder, isn't it better to have several different S&P 500 funds to diversify more? In reality, if they all replicate exactly the same index, you would just be duplicating the same exposure without any additional benefit. So, if the important thing is to choose a single ETF or fund that offers you solidity, a good track record, and low fees, we need to consider several key factors. First of all, there are the fees. Known as the expense ratio, this percentage, even if it seems minimal, can significantly reduce your profits over the years. For example, a fee of 0.09% versus another of 0.02% might seem insignificant today. But after 20 or 30 years, the differences in final returns are astonishing. Secondly, we should pay attention to liquidity and the date of creation. An ETF with high trading volumes gives you the ability to buy and sell easily. At the same time, an extensive performance history helps us see how the fund responds in times of prosperity and in times of crisis. Finally, the total volume of assets under management, also known as AUM, provides us with a clear indication of the overall scale and the level of trust that investors place in that specific investment vehicle. But before taking a closer look at each of the funds and ETFs that track the S&P 500, we should quickly review why this index is so popular and why it is so important for investors. In the world of investing, and that you're not just investing for the sake of it, but that you're really doing it based on knowledge, the S&P 500 brings together 500 leading companies that represent approximately 80% of the US stock market capitalization. This means that with a single investment, you're gaining access to the potential growth of iconic brands like Apple, Microsoft, Amazon, and many more. Companies that drive the global economy with their size and influence. History shows us that since its launch in 1957, the S&P 500 has delivered average returns of around 10 or 11% per year over the long term. Of course, this is an average. There are years of big gains and others of declines, but the historical trend has been positive. In fact, many professional traders who try to outperform the index end up falling behind after a few years. We can't invest directly in the index because it's not a financial asset in itself, but rather an indicator. To solve this, there are mutual funds and ETFs that replicate its components, buying the stocks with the same weighting that each company has within the S&P 500. The main difference between an ETF and a mutual fund or index fund is the way they are traded and their potential tax advantages. An ETF is traded on the stock exchange and can be bought on the exchange. or sold throughout the day just like a stock, whereas a mutual fund on the other hand is only valued once a day after the market closes, and you usually can't find it on all platforms but rather with the management company that created it or with brokers that have an agreement with them. Which one is better for you? If your approach is to buy and hold, there really isn't much difference in the long run. However, ETFs tend to be more tax efficient and often have lower fees in some cases. Now, if you prefer the simplicity of a mutual fund and your broker offers it to you without additional costs, that's just as valid. By the way, to be able to invest in these specific ETFs we're going to be talking about, I'll leave links in the description to the brokers where you can find them, or you might find direct alternatives to them. So in the description and in the first pinned comment, I'll leave you the links to these brokers. Now then, after talking about all this, we can start with the ETFs. The first on the list is the Vanguard S&P 500 ETF, or by its ticker symbol VOO. It's one of the most famous worldwide. Why is that? First, because Vanguard was a pioneer in index funds and its founder John Bogle laid the foundation for passive investing. VOO stands out for its low fee, as we mentioned earlier, also known as the expense ratio of around 0.03%, and a huge volume of assets under management totaling more than $900 billion. Its liquidity is high and it can be bought on practically any broker. Historically, VOO has delivered returns very close to the index and pays a dividend that ranges from 1.3% to 1.4% annually depending on market fluctuations. The second is the SPDR S&P 500 ETF Trust, also known by its ticker SPY. It is the oldest and one of the largest in the world, created in 1993. It has an expense ratio close to 0.09%, which is higher than Vanguard's, but its liquidity is enormous. SPI moves massive amounts of capital and liquidity every single day. So investors who trade frequently or engage in intraday trading often prefer it. However, if your long-term plan is to buy and hold for several years, so you might prefer the significantly lower expense ratios that other alternatives offer. In third place, we have the iShares Core S&P 500, also widely known by its ticker IVV, which is offered by BlackRock. IVV also charges very low fees of 0.03% and is currently the second largest option in terms of size after SPY. On the other hand, it doesn't have the same massive liquidity as SPY. But for a dedicated long-term investor who doesn't do daily trading, that should not pose any significant issue. The historical returns of this fund have been in line with the index exactly as expected, and its dividend is competitive for investors, ranging from 1.2% to 1.4%. The fourth option now among ETFs is the SPDR Portfolio S&P 500 ETF. I know they have. It is a long name, but that is why I am showing each of these ETFs on the screen. In this case, its ticker symbol is SPLG. This one belongs to the same family as the SPY, but it was created to compete specifically on costs. It has an expense ratio of just 0.04% or 0.02%, which makes it very attractive if you are looking for minimal fees. Also, its price per share is lower than that of SPY or VOO, which might interest those investors who do not have access to buy ETF fractions. Even though it is not as massive as SPY, it still maintains a substantial asset level, and in terms of returns, it aims to match the S&P 500 just like the others. In summary, which one should you choose? Pomo, if you are someone who does active trading, SPY is the king of liquidity for getting in and out constantly. Now, if your style is to buy and hold for a long time and you want to minimize fees, the best options are VOO, IVV, or SPLG, since these are excellent. They all track the same index, so their performance charts are almost identical in the long run. The differences come down to cost structure and ease of purchase. That's why you should check with your broker or the platform where you invest to see which of these is available for you to invest in. If you have more questions about investing in ETFs or the stock market, leave them in the comments section, and in the future we'll make a video addressing the questions from this video. See you. Bye bye.